PayPal's been trading sideways lately, looking like it's coiling up. We've done a deep dive, and today we're breaking down whether this digital payment giant is finally ready to make its move or if there's more pain ahead. So, what's the buzz around PayPal? Well, the narrative is definitely shifting. People are talking about a potential renaissance for the company, especially with that new multi-year partnership with Google aiming to really boost their commerce platform. Think about it, integrating PayPal more deeply into Google's ecosystem could be huge. But there's also a lingering concern about competition and whether PayPal can truly innovate fast enough to keep up in this rapidly evolving digital payment space. This partnership is a big signal, but the market is watching closely to see if it translates into real sustainable growth. For those new to PayPal Holdings Inc., they're a global technology platform that powers digital payments for both consumers and merchants worldwide. You know them from PayPal, Venmo, Zoom, Honey, and a host of other services. They operate in about 200 markets, handling payments in around 100 currencies. Management has been talking about accelerating growth, hinting at a strong 3-year outlook, and that's the forward guidance we'll be comparing our analysis against. Now, how do we reconcile the market chatter and the company's optimism with hard numbers? We've developed 3 scenarios to paint a clearer picture. First up, the base case. This scenario assumes PayPal nails its strategic transformation, using partnerships like the Google deal as a springboard. We're looking at continued profit improvements and steady but not explosive revenue growth. The valuation here starts by projecting a 7% revenue CAGR, leading to an estimated $43 billion in revenue by 2029. With a projected 15% net income margin, that's about $6.45 billion in net income. Applying a reasonable PE multiple of 15x, considering moderate growth, we get a market cap around $96.75 billion, translating to a fair value of about $101.26 per share. However, acknowledging the current technicals and the need for execution, we've tempered this down to a more grounded $72.50. Then we have the bull case. This is where PayPal truly hits a home run. Imagine accelerated growth, with the Google partnership being a massive catalyst, leading to significant increases in merchant adoption and transaction volumes. In this scenario, we're projecting a more aggressive 10% revenue CAGR, hitting roughly $49.2 billion by 2029. With an improved net income margin of 17%, that's about $8.36 billion in net income. Applying a higher PE multiple of 18x, reflecting strong market leadership, we get a market cap of around $150.5 billion. That works out to a fair value of about $157.53. But, being realistic about what it takes to get there, we've set our bull case fair value at $85. Finally, the bear case. This scenario sees intensified competition, slower adoption of new products, and persistent macroeconomic challenges. Revenue growth slows and margins get squeezed. Here, we're looking at a 4% revenue CAGR, reaching about $37.2 billion by 2029. The net income margin drops to 12%, yielding around $4.46 billion in net income. With a more conservative PE multiple of 13x, we arrive at a market cap of about $58 billion, giving us a fair value of roughly $60.71 per share. We've rounded this down to $58. So, why these probabilities? The base case gets the highest weighting at 55% because it strikes a balance between the potential of new strategies and the current market realities. The bear case, however, gets a significant 30% probability. This is heavily influenced by the technical picture. If the stock fails to hold key support, a sharp decline is very possible. The bull case, with its 15% probability, represents a strong upside scenario, but it requires a lot of things to go perfectly right. All right, let's pull up the chart. Here's what I'm seeing. PYPL is currently stuck in a multi-week bear flag pattern, basically consolidating between $67 and $70. This kind of pattern often suggests more downside is coming. If it breaks below this consolidation zone, the next major support level we're looking at is around $57. On the flip side, if it manages to break out to the upside, the key resistance level to watch is $76. So, to wrap it all up, PayPal is at a crossroads. The Google partnership is a positive signal, but the stock is technically stuck in a bear flag. Our base case fair value sits at $72.50, with the bear case suggesting a potential drop to $58 and the bull case offering upside to $85. Given the current technical setup and the need for continued execution to prove the new strategy, we're leaning towards the base case, but the risk of the bear case is very real, especially if that $67 support gives way. Based on our analysis, potential buy levels to watch would be around the $58 to $60 range, aligning with our bear case fair value and the technical support. A more aggressive entry might be considered closer to $70 if the price shows signs of stabilizing within the current range, targeting the $72.50 base case. Significant upside potential would only be considered on a confirmed break above the $76 resistance, aiming for our bull case target. What do you think about PayPal? Are you buying the dip or waiting for more confirmation? Let me know in the comments. Comments below. And if you found this analysis helpful, please hit that like button, subscribe to Is the Bottom In for more deep dives, and ring that notification bell so you don't miss our next episode. This video is for informational and entertainment purposes only and does not constitute financial advice. Investing in the stock market involves significant risk, including the potential loss of principal. Past performance is not indicative of future results. Always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. We are not responsible for any losses incurred as a result of the information presented in this video.